The statistic is sobering. Between 85% to 96% of retail traders lose money and eventually quit trading. Only a microscopic 5% achieve consistent profitability over the long term. This isn't just another motivational piece about mindset and discipline. This is a deep dive into the documented reasons why the majority fail and what separates the elite 5% from everyone else. If you're reading this, you're probably one of two people. Either you're considering entering the markets, or you've already lost money and want to understand why. This book will give you the unfiltered truth backed by research, statistics, and real market psychology. The journey from novice to profitable trader is brutal. Research shows that 40% of day traders quit within just 1 month, and only 13% remain active after 3 years. Even more shocking, only 1% of traders maintain profitability over 5 years. These aren't opinions, these are documented facts from broker data and academic research. Chapter 1. The numbers don't lie. The real failure rates. Let's establish the facts first. Different sources report varying failure rates, but they all paint the same grim picture. According to mandatory disclosures from regulated brokers, the actual loss rates for retail traders are: Interactive Brokers, 58% of retail CFD traders lose money. Saxo Bank, 65% of retail accounts lose money. eToro, 67% of retail accounts lose money. CMC Markets, 71% of retail accounts lose money. Plus 500, 72% of retail accounts lose money. IG Group, 81% of retail spread betting accounts lose money. These numbers represent traders who are actively losing capital. They don't include the massive percentage who quit before reaching these statistics. When you factor in the dropout rate, the true failure rate climbs to 90 to 96%. The attrition timeline. The failure happens in stages. Month 1, 40% quit after realizing trading isn't what they imagined. Month 6, only 13% maintain any level of profitability. Year 3, only 13% are still actively trading. Year 5, only 1% achieve consistent long-term profitability. These aren't opinions, these are documented facts from broker data and academic research. Why these numbers matter. Understanding these statistics isn't about discouragement, it's about calibration. Most people enter trading with completely unrealistic expectations, thinking they can turn a few $1,000s into millions within months. The data shows this is fantasy. The 5% who succeed don't have secret strategies or magical indicators. They have something far more valuable: realistic expectations, proper education, disciplined execution, and the ability to survive long enough to develop genuine skill.
Chapter 2. The 7 Deadly Sins of Failed Traders. Research across multiple studies has identified consistent patterns among failing traders. These aren't random mistakes, they're systematic failures that repeat across demographics, markets, and time periods. Sin 1. No trading plan. The majority of retail traders enter the market without a clearly defined trading plan. They make decisions based on emotion, news headlines, or random tips from social media. This is the equivalent of walking into a casino and betting your life savings on red. A trading plan must include specific entry criteria based on technical or fundamental analysis, predetermined exit points for both profits and losses, position sizing rules based on account size and risk tolerance, maximum daily loss limits, trading hours and instruments to focus on, and record-keeping and performance review processes. Without these elements, you're not trading, you're gambling. Sin 2. Poor risk management. The single biggest difference between winners and losers is risk management. Failed traders violate basic risk management principles, risking more than 1 to 2% of capital on a single trade, not using stop losses or moving them further away when losing, letting losses run while cutting winners short, revenge trading after losses to get even, over-leveraging positions to chase bigger gains. Professional traders understand that preservation of capital is the primary objective. Making money is secondary. If you don't lose, you stay in the game long enough to eventually win. Sin 3. Emotional decision-making. Markets punish emotional thinking more severely than almost any other error. The psychological challenges include fear, which causes traders to exit winning positions too early, missing the majority of profit potential. Greed makes traders hold losing positions, hoping they'll turn around. Revenge after a loss, the emotional desire to recover money immediately, leads to impulsive trades with poor risk-reward ratios. Overconfidence, a few winning trades, creates false confidence, leading traders to increase position sizes before they've proven consistent profitability. Research in behavioral finance shows that winning traders have developed emotional control through experience and systematic processes. They treat trading as a probability game, not a certainty game. Sin 4. Insufficient market knowledge. Many traders fail because they simply don't understand what they're trading. They don't know how their chosen market actually works, what drives price movement in their instruments, the relationship between different time frames, how to read price action and market structure, the impact of major economic events or news, the characteristics of different trading sessions. Trading without understanding market fundamentals is like performing surgery after watching YouTube videos. The market will expose your ignorance quickly and expensively. Sin 5. Lack of discipline and patience. The most profitable trading strategy in the world is worthless if you can't follow it consistently. Failed traders exhibit overtrading, the compulsion to always be in the market, fearing they'll miss opportunities. This leads to taking low probability setups and increased transaction costs. System hopping, abandoning strategies after a few losses instead of allowing them to play out over a statistically significant sample size. Rule breaking, having a plan but deviating from it when emotions take over. Successful traders understand that trading is boring. The excitement comes from consistently executing a proven process, not from the thrill of the trade itself.
Sin 6. Unrealistic expectations. Most traders enter the market expecting to double their account monthly. This is why they fail. Professional hedge funds that consistently return 15 to 20% annually are considered exceptional, yet retail traders expect to make that in a week. These unrealistic expectations lead to excessive risk-taking to achieve impossible returns, disappointment and emotional trading when results don't match expectations, abandoning strategies that are actually profitable because they're too slow, and seeking out high-risk systems that promise extraordinary returns. The 5% who succeed have adjusted their expectations to reality. They understand that consistent 2 to 3% monthly returns compound into life-changing wealth over time. Sin 7. Inadequate education and practice. Trading is a skill that requires thousands of hours of deliberate practice to master. Failed traders skip the education phase and jump straight to live trading, don't spend time in demo accounts or simulators, fail to backtest their strategies, don't keep detailed trading journals, never review and analyze their performance, and quit too soon before accumulating sufficient screen time. The successful 5% treat trading like any other profession. They study, practice, review, and continuously improve. They understand that expertise takes time to develop. Chapter 3. The Psychology of the 5% Winners. Research into successful traders reveals consistent psychological characteristics that separate them from the majority. Accepting risk and uncertainty. Winning traders possess a fundamental acceptance that they will be wrong frequently. They understand that trading is a probability game where no single trade determines success, losses are a cost of doing business, Being right 40 to 50% of the time can still be highly profitable with proper risk management, and uncertainty is permanent and must be embraced, not fought. This acceptance allows them to execute trades without hesitation when their setup appears and exit without emotion when they're wrong. Self-confidence without ego. The most successful traders have unwavering confidence in their ability to be profitable over time, but zero ego about individual trades. They don't need to be right to feel good about themselves, can admit mistakes immediately without internal conflict, view each trade as a data point, not a referendum on their intelligence, and remain flexible and willing to change their analysis when price action contradicts their thesis. This combination of confidence and humility is rare but essential. Discipline through systems. Winners replace willpower with systems. They understand that willpower is a finite resource that depletes under stress. Systems and checklists prevent emotional decision-making. Following a proven process matters more than short-term results, and consistency compounds into edge over time. They trade the same way every single day, regardless of recent wins or losses. Focus on process over outcomes. The psychological shift that defines winning traders is focusing on what they can control. They measure success by adherence to their trading plan, quality of execution on valid setups, risk management consistency, proper position sizing, and following their rules. They understand that if the process is correct, profitable outcomes are inevitable over a large sample size. Continuous learning and adaptation. Markets evolve. Winning traders never stop learning. They regularly review and analyze their trades, study their losses more intensely than their wins, stay informed about market conditions and economic factors, adjust their strategies when market dynamics change, and seek feedback and mentorship from more experienced traders. They view trading as a craft that requires lifelong dedication to mastery. Resilience and emotional recovery. Losses don't break successful traders. They possess the ability to quickly recover from drawdowns, mental frameworks that contextualize losses as expected variance, support systems and routines that maintain psychological balance, perspective that keeps trading results from defining their self-worth. They bounce back from setbacks faster and more completely than average traders. Chapter 4. The technical foundation of the 5%. Beyond psychology, successful traders possess genuine technical skill that takes years to develop. Understanding market structure. Winners can read price action and market structure across multiple time frames. They understand support and resistance zones, trend identification and structure, market phases, accumulation, markup, distribution, and markdown. How institutional players move prices, order flow and liquidity concepts, the relationship between time frames. This isn't memorizing patterns, it's developing an intuitive feel for how markets move. Having a genuine edge. Successful traders have identified and thoroughly tested a legitimate edge in the market. This edge might be superior timing on common patterns, better risk management on standard strategies, specialization in specific instruments or sessions, unique combinations of indicators that provide probability advantages, or exploiting inefficiencies in specific market conditions. They've proven this edge through extensive backtesting and forward testing before risking significant capital. Mastering risk management mathematics. The 5% understand position sizing, risk-reward ratios, and win rate mathematics. They know how to calculate proper position sizes based on stop distance and account risk, why a 40% win rate with 3-to-1 risk-reward is highly profitable, how to adjust position sizes during winning and losing streaks, the mathematics of compounding returns, maximum drawdown tolerances, and capital preservation. This mathematical literacy separates amateurs from professionals. Developing pattern recognition. Through thousands of hours of screen time, successful traders develop genuine pattern recognition abilities. They can identify high probability setups quickly,
Distinguish between similar-looking patterns with different outcomes. Recognize when market conditions favor their strategy. Spot when conditions have changed and require sitting on hands. This skill cannot be taught through books. It only develops through experience.
Chapter 5. The Practical Path from Failure to the 5%. Understanding why most traders fail is valuable only if it informs a better approach. Here's the documented path that increases your probability of joining the successful minority. Stage 1. Education before execution. Before risking any real capital, study market fundamentals for your chosen instruments, forex, stocks, crypto, etc. Learn technical analysis basics, support and resistance, trends, indicators. Understand trading psychology and behavioral finance. Study risk management principles and position sizing. Learn from documented successful traders, not social media gurus. Minimum time investment, 3 to 6 months of serious study. Stage 2. Strategy development and testing. Develop your approach systematically. Choose a specific strategy that fits your personality and schedule. Backtest it thoroughly on historical data, minimum 100 trades. Identify its win rate, average win-loss, and maximum drawdown. Define specific entry and exit rules with zero ambiguity. Create a written trading plan document. Establish risk management rules, position sizing, maximum daily loss, etc. Minimum time investment, 2 to 4 months of testing and refinement. Stage 3. Simulated trading. Before live capital, trade your strategy in a demo account or simulator. Track performance in a detailed journal. Focus on execution quality, not profit or loss. Develop your trading routine and habits. Test your emotional response to wins and losses, even simulated. Prove consistency over minimum 3 months or 100 trades. This stage separates those who are serious from those who are gambling. Stage 4. Small capital live trading. Begin with real money but minimal amounts. Start with the smallest position sizes possible. Focus entirely on process execution, not profits. Experience real emotional responses to actual money. Refine your strategy based on live market feedback. Maintain detailed records and regular reviews. Prove profitability over minimum 6 months. Many traders skip this stage and jump to large positions. This is why they fail. Stage 5. Gradual scaling. Only after proving consistent profitability. Increase position sizes slowly, 10 to 20% increases, not doubling. Monitor performance carefully during scaling. Be prepared to scale back if performance deteriorates. Continue focusing on process over results. Maintain the same discipline that created initial success. The path from novice to the 5% takes minimum 2 to 3 years of dedicated effort. There are no shortcuts. Chapter 6. The Hard Truths Nobody Wants to Hear. Trading might not be for you. Not everyone can become a successful trader, regardless of education or effort. Some people cannot handle the emotional stress of uncertainty, lack the patience required for proper development, don't have sufficient capital to trade safely, have personality traits incompatible with trading success, don't dedicate the time required to develop expertise. This isn't a moral judgment. Some people aren't built to be surgeons, some aren't built to be traders. Recognizing this early can save years of frustration and capital. Capital requirements are real. You cannot turn $500 into $1 million through trading skill alone. The mathematics don't work. You need sufficient capital to risk 1 to 2% per trade while maintaining meaningful position sizes. Emergency funds so trading capital isn't needed for living expenses. For most strategies, this means minimum $10,000 to $25,000 to trade properly. Less than this forces excessive risk-taking. The market doesn't owe you anything.
Markets exist to transfer wealth from the impatient to the patient, from the undisciplined to the disciplined, from the emotional to the systematic. The market will exploit your weaknesses repeatedly, punish emotional decisions severely, reward patience and discipline inconsistently, create conditions that make proper trading feel wrong, provide no sympathy for losses or failures. You must adapt to the market. The market will never adapt to you. Success takes longer than you think. The timeline to consistent profitability is measured in years, not months. Most successful traders report 2 to 3 years before achieving basic consistency, 3 to 5 years before achieving significant income, 5 to 10 years before achieving mastery. Anyone promising faster results is either lying or statistically ignorant. You will lose money. Even after becoming consistently profitable, you will have losing days, losing weeks, losing months, painful drawdowns, and periods where nothing seems to work. This is normal variance. The 5% accept this. The 96% let it destroy their confidence and account. Chapter 7. Building your trading business. The 5% treat trading as a serious business, not a hobby or get-rich-quick scheme. Infrastructure and tools. Successful traders invest in reliable trading platforms with backup systems, quality charting software and analysis tools, fast internet connections with backup options, proper workspace free from distractions, trading journals and performance tracking systems. These aren't optional luxuries, they're business expenses. Record keeping and analysis. Winners maintain detailed records of every trade, entry and exit prices, position size and risk amount, setup type and market conditions, emotional state before and during the trade, what went right and what went wrong, market context and time frame confluence. They review these records weekly and monthly, identifying patterns in their performance. Continuous improvement process. The 5% have systems for improvement, regular performance reviews, weekly, monthly, quarterly, specific metrics they track beyond profit and loss, goals for process improvement, not just profit targets, accountability through mentors, trading groups, or journals, and adjustment protocols when performance deteriorates. They never stop working on their craft. Risk management systems. Successful traders have multiple layers of protection. Per trade risk limits, typically 0.5 to 2% of capital, daily loss limits, typically 3 to 6% of capital, weekly and monthly loss limits, position size calculators to ensure consistency, rules for reducing size during losing streaks, rules for when to stop trading entirely. These systems prevent catastrophic losses that end trading careers.
Chapter 8. The Mindset Shift. Joining the 5% requires fundamental shifts in how you think about trading. From prediction to probability. Failed traders try to predict what the market will do. Successful traders think in probabilities. No single trade matters. Edge plays out over hundreds of trades. Losses are expected and planned for. Focus on executing probability advantages repeatedly. This shift eliminates the emotional pain of being wrong on individual trades. From getting rich to getting consistent. Failed traders focus on making money. Successful traders focus on consistency. Executing their plan perfectly regardless of outcome. Following their risk management rules without exception. Trading only their highest probability setups. Maintaining emotional equilibrium through wins and losses. Ironically, focusing on consistency rather than money is what creates sustainable profitability. From action to patience. Failed traders feel they must always be doing something. Successful traders understand that the best trade is often no trade. Patience for proper setups is a competitive advantage. Overtrading destroys edge through transaction costs and lower probability entries. Sitting on hands when conditions are poor is an active skill. The market rewards patience more than activity. From individual to business. Failed traders treat trading like gambling. Successful traders treat it like operating a business. They have business plans, trading plans. They track metrics and KPIs, win rate, risk-reward, expectancy. They make strategic decisions based on data. They invest in education and tools. They focus on long-term sustainability. This perspective shift changes everything. Conclusion: the choice is yours. The statistics are clear. 96% of traders fail. The reasons are documented and consistent. The path to joining the 5% is known and proven. You now understand the real failure rates and why they're so high. The 7 deadly sins that kill trading accounts. The psychological characteristics of successful traders. The technical foundations required for consistent profitability. The practical stages from novice to professional. The hard truths about capital, time, and personality fit. The business systems that support sustainable trading. The difference between failure and success isn't intelligence or luck. It's realistic expectations about the time and effort required. Disciplined execution of proven strategies. Emotional control developed through experience and systems. Risk management that preserves capital during inevitable drawdowns. Continuous learning and adaptation to changing markets. The humility to admit mistakes and the resilience to continue improving. Most people who read this will still fail. They'll skip the education phase, they'll overtrade, they'll risk too much. They'll quit after losses, they'll chase easy money instead of developing genuine skill. But some of you won't. Some of you will treat this as the serious profession it is. You'll put in the work, you'll develop the skills, you'll control your emotions, you'll follow the process. Those people will join the 5%. The market doesn't care about your background, education, or past failures. It only cares about what you do next. Every successful trader was once a novice who lost money. The difference is they didn't quit. They learned, they adapted, they persisted. The path is difficult. The attrition rate is brutal. The timeline is longer than you want, but the path exists and it's proven. The question isn't whether you can become a consistently profitable trader. The question is whether you're willing to do what it takes. Choose wisely.